but I want to tell you a story to convey why it is so important to not get a discount mortgage. Interest rates are going crazy right now with bond market yields dropping to the lowest they've been since August. And subsequently, 5-year fixed rates are dropping as well, with several lenders leading the way and dropping rates quite substantially, likely due to the fact that their year ends have come and gone, and with a softer market, they're looking to get more competitive again to steal market share. And I'm going to show you exactly what's going on with interest rates all across the country. But before we do, my name's Nolan Matthias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and click that like button so more people like you can see this video. All right, so let's jump into what's going on in the interest rate world right now. Bond market yields are down substantially. I'm not sure what's going on there. There's some weird activity in the bond market today, which is leading for an opportunity for lenders to start lowering their 5-year fixed rates and start to gain back some market share as we enter the slower season and head into the new year. Because what tends to happen this time of year is all the banks have October and November year ends. And as they hit those year ends, their targets all refresh and they start to get more competitive in the market again. And we're seeing this right now with different lenders in different parts of the country come out with some amazing rate specials, which I'll tell you about at the end of this video. But there's also the added piece of this year with higher interest rates. The real estate market is starting to slow down, and that is leading to many lenders having a lot of capacity within their underwriting centers. And with that capacity comes the desire to get those people working and get more business so that they don't have to do layoffs. So one thing that most people should be seeing across the board in the industry right now is better service. We're back to getting approvals within a couple of hours and documents being reviewed within a day or two, which is absolutely phenomenal. So the mortgage process as of right now has a lot less friction than it did a year ago because there's more bandwidth and more time in the underwriting centers, as well as more bandwidth with brokers. So people are getting the care and the attention that they were used to pre-pandemic. Now, obviously, this leads us into the conversation with respect to interest rates. So I'm going to jump you in. I'm going to show you exactly what's going on with rates right now. And the good news is that a lot of rates are getting better, especially for people who are getting insured mortgages or have greater than 35% down. So let's look first and foremost at 5-year fixed rates. These are the full feature rates. They have all the bells and whistles, the best prepayment privileges, and the lowest penalties. So these are mostly non-bank mortgages as well because they have those better penalty calculations. And by the way, with interest rates fluctuating, and we expect they're going to fluctuate, especially if we enter into a recession in the next year, well, you want to make sure that you have your mortgage with a lender who has really beneficial payout penalties so that when interest rates go down, you can get into a lower rate mortgage. This is not the time to be going and taking a 5-year fixed with your big bank. By the way, if you have a variable rate mortgage with a big bank and you're looking to lock in, you should be looking to switch to a different lender, a monoline lender, a non-bank lender that has lower penalties, because when those rates do go down, again, you want to have that ability to get into a lower interest rate. So let's start first and foremost by looking at insured rates. We're now down to 5.19%, which is the best that we've seen 5-year fixed rates in quite some time. Now, of course, insured mortgages are the lowest risk for the banks, so these tend to have the lowest interest rates because obviously if somebody defaults, there's mortgage insurance, so the bank is protected. Then moving into 20% down, this is where you're going to pay the most. In the past, it used to be you want to get to 20% down so you could avoid CMHC premiums. Well, nowadays, 20% down represents the riskiest mortgages for the bank because these are the mortgages that are the biggest that don't have insurance. So they're typically priced the highest. So we're now at 5.49%. There's no change in this rate from October. When we get into the 25% down payment, you're looking at 5.44%. And when you get to 30% down payment, you're again looking at 5.44%. By the way, I fully expect with bond market yields down as much as they are, that these rates are probably going to come down in the next 2 or 3 days. So stay tuned to this channel because we'll update you when they do come down. And then when you get to 35% down, again, these represent very low risk mortgages for the bank. So you start to get back into those insured rates again at 5.19%. And then if you're looking to refinance, if you're looking to purchase over $1 million, if you're looking for a 30-year amortization, then you're looking at what we call uninsurable rates, and these are priced significantly higher. They're 5.54. There are going to be some opportunities to get uninsurable rates at slightly better rates in the coming weeks here. I'm sure of that, but as of right now, that's where you're at. Now, moving into variable rate mortgages, some of the discounts here have gotten better as well. We're seeing insured variable rate mortgages at prime minus 0.9, so that would be 5.05%. So by the way, this is one of those times where we're seeing fixed rate mortgages priced higher than variable rate mortgages, which is often an indication that the fixed rate might be better. However, we do have to pay attention to what's happening with economic forecasts, because if we are leading into a recession here right now, then there is a chance that we could find ourselves in a situation where interest rates are coming coming down. So again, penalty is kind of the theme of the day right now. No matter what you do, you want to make sure you're with a lender that has a low penalty, because if interest rates do start to come down, you want to be able to get into those lower rates. Now, with 20% down, you're looking at prime minus 0.55, which is 5.4%. Moving into 25% down, similar sort of rate. When you get to 30% down, you get a little bit more of a discount. And when you get to 35% down, you're looking again at prime minus 0.9. By the way, there's some things that we can do with a couple of lenders here, non-bank lenders, where if somebody is looking at putting 25 or 30% down, there are some opportunities for us to do things like match them up with a little bit of a line of credit and a little bit of a mortgage and get a little bit better interest rate than what's otherwise available. So that's something to keep in mind. Mortgage planning and strategy right now is so important, and having a good broker and somebody who can guide you through those things, who can get you a lower rate because maybe you take a line of credit with your mortgage instead of not taking a line of credit with your mortgage, is crucial to saving money over time. Like I've said before, anybody can save you 0.1 or 0.2%, but being able to find better rates for you and find unique and strategic options is where a really great broker sets themselves apart. So we're finding right now that we can save clients 0.2 to 0.3% by using some really interesting strategy and making sure that they have the right mortgage or a different structure that will give them the opportunity to get a lower rate. So basically move them into that 35% down category rather than that 20% down category. And then refinances and mortgages greater than $1 million, we're looking at prime minus 0.5. That rate has actually gotten better since last month, which is a really good thing. So now moving into discount mortgages. So these are the 5-year fixed discount mortgages. What do I mean by discount mortgages? Well, often when you get a really great rate, it comes with some restrictions, some surprises. You don't walk into a car dealership and see two cars that look identical. One has a price tag of $45,000, one has a price tag of $55,000, and not look for the differences. And there are differences here when you start to get into ultra low rate mortgages. By the way, when I get to the end of this video, I'm going to tell you about one rate special that is really good on a full featured mortgage that will pretty much make these discount mortgages irrelevant because it is such a good deal. By the way, if you want to know more about discount mortgages and you want to know about negotiating the mortgage for yourself, the best place to get information on that is at ratesecrets.ca. You can get our Secrets to Getting the Lowest Interest Rate course, which will prevent you from making any mistakes and jumping into a discount mortgage and getting yourself in trouble because you didn't know there was a bona fide sale clause or some sort of restriction that ultimately one day is going to end up costing you more money. But without further ado, let's jump into what these rates are. So insured mortgages, 4.89%, again, one of the best rates we've seen since August. Then getting into 20% down, you're looking at 5.14%. At 25% down, you're looking at 5.09%. At 30% down, you're looking at 5.09 again. At 35% down, you're looking at 4.89. And by the way, once you start getting into those uninsurable mortgages, you start to get up to pretty high rates again. Now, here's the thing about discount mortgages, and I really haven't explained this as well as I should have in the past, but I want to tell you a story to convey why it is so important to not get a discount mortgage. So a few years ago, actually about 10 years ago, it was 2012, we had a client, actually a friend of mine, who was diagnosed with cancer. And he was told by the doctors in Calgary that he had no more than 5 years to live and he should start making his arrangements. And, this is the type of guy who he's not one to take somebody's word for it, which is amazing. By the way, he's like one of the guys who used to shop around all the time on me. Really good friend of mine. He'd go and look for better rates on mortgages just because he wanted to know for sure that he was getting the best deal with me. And of course, he was getting the friends and family discount. So he was always getting the best mortgage, but he always just wanted to get that second opinion. And with his cancer diagnosis, it was no different. He ended up going down to the Mayo Clinic in the US, and they looked at his diagnosis and they said, no, we see this all the time. We can do a surgery and we can remove it and it will more than likely never come back. And again, this was 10 years ago. So he goes down there. The surgery cost him $120,000. He had to refinance his home to do it, but refinancing his home and paying that $120,000 saved his life. So 10 years later, he's cancer free. And here's the reason why I tell you the story is because if he would have had a discount mortgage, which was super popular at the time, he would have saved 0.1 or 0.2% on his mortgage, but he would have lost the ability to refinance. And losing that ability would have probably not cost him his life. I'm sure he would have found a way to come up with $120,000, but it would have made it significantly more difficult for him to find that money. So not having that discount mortgage allowed him to go get his surgery, come back and be cancer free today, which is so important in my mind, which is why we always encourage people to watch out. Now, that's the extreme case. The other cases are this. If interest rates go down and they're dropping right now, you can see this, right? Take a look. There's a lot of green dots there indicating that rates are going down. Well, if you don't have the ability to refinance or switch to a different lender, guess what? You're pretty much stuck where you are and you have to pay the higher interest rates. By the way, if you have a big bank 5-year fixed mortgage, you've got the same restrictions because if interest rates go down, you aren't going to be able to switch to a different lender. You're going to have a massive penalty and you're going to end up being stuck in these higher rates for longer. By the way, the type of people that we couldn't help in 2020, 2021 during the pandemic when interest rates fell to their lows was the people who had big bank mortgages, big bank 5-year fixed that had massive penalties. We weren't able to refinance them. We weren't able to get them lower interest rates, and they were never able to take advantage of those super low rates. So having a mortgage with a lender like a CMLS, a First National, or an MCAP is so important because that will allow you to do the things you want to do when it comes to getting lower interest rates down the road. So I can't emphasize that enough. Now, moving into variable rate mortgages, variable rate discount mortgages, I don't see any reason to take these, but I put them here because if you Google best rates in Canada, you're going to find them. So I want you to know what you're getting into. They are insured prime minus 1.15%. When you put 20% down, you're looking at prime minus 0.8%. At 25% down, again, prime minus 0.8. At 30% down, you get to prime minus 1, so basically 4.95%. So if you see somebody advertising 4.95% variable, chances are it's one of these discount mortgages. When you get to 35% down, you're looking at prime minus 1.15, which is again similar to that insured rate. And then uninsurable, you're looking at prime minus 0.5. Now, at the beginning of this video, I promised you there is a rate special out there that is phenomenal, especially for first-time homebuyers or people buying under $1 million. As of right now, just because of how competitive the market is and how much lenders are trying to steal back some market share, there are a bunch of lenders across Canada offering insured rates at 4.89% on full-featured mortgages. So if you can pick the right lender with the right broker and end up getting that 4.89 without it being a discount mortgage, it's probably one of the best deals out there. They have low payout penalties and they have the options down the road to be able to refinance into lower interest rates. In addition to that, if you're still in fear of interest rates going up, there are 10-year rates that are not much more expensive than 5-year fixed right now, looking in that 5.84 to 5.94 range. So there's some really good options out there to be had, especially with the non-bank lenders. And by the way, like I've said before, let's call a spade here. The non-bank lenders have to have better mortgage products than their big bank counterparts. The reason why is simple. If they didn't, they just wouldn't exist. They wouldn't survive. So you can rest assured that a lot of the time when you're getting a mortgage at a place, like I said, like CMLS or MCAP or First National, you are absolutely getting a better product than what you would be getting at an RBC or a TD or a Scotiabank or a CIBC or a whatever the fourth one is. I can't remember. Oh yeah, BMO. Or a BMO. So that's your interest rate update for December of 2022. Make sure you check out this video here, which now has over 115,000 views. It is one of the most popular videos ever on this channel about the Bank of Canada bringing the pain. It's got a lot of really important interest rate information in it, so make sure you check out that one as well.